Most people doing retirement planning typically know very little about their taxes. Year over year, you just hand over a stack of paperwork to your accountant and then later accept without question the accountant's tax filing because you don't understand it and just want to get it over with. As your virtual retirement planning partner, today we're going to go line by line and break down the 1040 tax return for the purposes of retirement planning. What can we do to lower taxes? How can we invest smarter? And what other opportunities could there be? And those things are exactly what my firm helps with. And if we haven't met yet, my name is Will, and I'm an IRS enrolled agent and financial planner. And the good news is today we're going to go through that, but we also have a free retirement planning guide that shows you some of the things we look at when we help clients lower taxes and invest smarter. So click the link in the comments to grab that. And I'll try not to bore you to death today. So before you fall asleep, remember to smash that subscribe button and leave me a comment. I read and respond to every one of them. And the purpose of this video is just to help you clearly understand what you're seeing when you look over your tax return. As the person signing it, you're legally responsible for its accuracy. So it's important to know what to look for. And a tax return isn't just a set of numbers. It tells your financial story. So if you're unsure whether it all makes sense, you could end up paying more than necessary in tax. And most tax professionals do great work, but they're only human. And during the busy tax season, mistakes can slip through and important planning opportunities might be missed. So we're about to get real nerdy here, so let's jump in and take a look. All right, let's take it from the top here. We're on tax year 2024, Form 1040, and the Form 1040 is used by all U.S. resident taxpayers to file an annual income tax return. And the 2025 form isn't available yet, but the lines and layout on these do change a bit from year to year. And there's also Form 1040 SR for taxpayers who are age 65 or older. And 1040 SR is exactly the same, it just has a little bit larger text to make it easier on the eyes. And I'm going to go through this top part pretty quick. Up top here, this is just personal information section. Really isn't much to see here, but this will be where you'll enter your name and your spouse's name, if applicable, and then your address and social security numbers here. And pretty straightforward, just confirm the accuracy of this section because mistyped socials or names can delay things and just generally cause headaches. So coming down here to filing status, it just kind of is what it is. If you're married, you're going to mark married filing jointly. And if you are married, it's rarely better to file separately. But there are some situations, if you have student loans and a few other situations, where it might make sense, but generally that doesn't apply to those in retirement. If your spouse passes away during the year, you can still file jointly for the rest of that year, which is an opportunity because once you start filing single, you'll usually end up in a worse tax situation. Head of household status typically doesn't apply to retirement planning, but it may be relevant if you're single and caring for a dependent child, parent, or disabled relative, provided they live with you for more than half the year. Qualifying surviving spouse will only be an option for 2 years after your spouse passes away, and only when providing housing and financial support for a dependent child. And again, this usually won't apply when planning for retirement. This line here, digital assets, is if you sold any crypto in the past year. And the IRS has been increasing its scrutiny of crypto transactions. So if you sold any Bitcoin or Dogecoin or something, you'll want to answer that correctly. Well, in the standard deduction section, being a dependent usually won't apply when retirement planning. But if it does, check that. And this age blindness question is important because if you're 65 or older and or blind, there's an additional standard deduction available. And most retirees don't have dependents, but if you do, be sure to list them because there are some additional child and dependent care credits over here. And all right, we're in the main part of this 1040 now, the meat and potatoes. And line 1 is W-2 income. And if you're retired, there likely won't be any wages, but if there are, there could be some other planning opportunities around employer-sponsored plans. There's also various other types of wages here down below. Line 2, taxable and tax-exempt interest. And 2A is tax-exempt interest, which would mainly be municipal bonds. And so if you own muni bonds and a taxable brokerage account, that interest is tax exempt at the federal and likely the state level as well if you live in a state with income tax. Line 2B is taxable interest. And this could be taxable bond or CD interest or interest earned from a bank account. And if this number is really high, you could be holding more cash than necessary, or there could be some opportunities to optimize your asset location. Lines 3A and 3B are qualified and ordinary dividends, and most U.S. stocks will pay qualified dividends. And why does this matter, you ask? Well, qualified dividends are taxed more favorably than ordinary dividends. So if you have a lot of ordinary dividends, it might be worth digging deeper into your portfolio to find out why. And these numbers flow into the 1040 from Schedule B. So if you need more information, that's a good place to start. So lines 4A and B are IRA distributions, and the line 4A will be the gross amount, and the taxable portion will be here on 4B. And generally, if 4B is less than 4A, there's some after-tax basis in the IRA. So, which means that there was likely some after-tax IRA contributions made or possibly Roth recharacterizations done at some point. And Form 8606 calculates how much of an IRA distribution is taxable. And if there is any after-tax basis, any distributions or Roth conversions will be partially taxable. Lines 5A are pension and annuity distributions. So if you don't have a pension or annuity or that you took money from throughout the year, this will be blank. And same idea here on as above on 4A and B. When it comes to annuities, if you surrendered a non-qualified annuity, it'll likely only be partially taxable due to a portion being return of your initial contribution. Lines 6A and 6B are Social Security benefits, and 6A is gross benefit before any withholdings or taxes. Line 6B shows the taxable portion of Social Security. And the taxable portion of Social Security could be anywhere from 0 to 85%. And at a high level, the amount taxed is based on how much other income you have. The more income you have, the more taxes you'll pay on your Social Security. And there's more than that goes into it, but we'll just leave it at that for today. And an opportunity to save some taxes on your Social Security benefits could be to control the amount of income you take and from where. And in reality, this might just be kicking the can down the road, but could be worth analyzing the pros and cons with your advisor. Line 7 is capital gains and losses. And this is going to be from selling in a taxable brokerage account and will either be a short-term or long-term gain or loss. And just for your information, long-term capital gains, which are investments held for over 1 year, are taxed more favorably than short-term capital gains. And Schedule D will outline all the activity that flows through to get to this number on line 7. If there is no Schedule D in capital gains, that likely means that you held mutual funds in a taxable account and the fund passed through some capital gains. It also means that you could maybe change some things to invest more tax efficiently, but you just can't go selling stuff all willy-nilly in a taxable account because that could cause more tax problems. That's why you need a plan to do this in the most tax efficient way possible. And if the number on line 7 here is negative 3,000, that means you had a capital loss for the year and can deduct up to 3,000 of losses against your regular income. If there is more than $3,000 in losses, which there usually is, those losses will be carried forward and can be used to offset income in future years. And you could absorb those losses by selling other investments at a gain and using the capital losses to offset that capital gain. Line 8 is income that flows through from Schedule 1, and this could be many different things, from business interest to rental income. And what we see a lot here in my hometown of Las Vegas is gambling winnings, but also some losses, because the house always wins, right? And it's also worth noting that you can deduct gambling losses up to the amount that you won. Coming on here down to line 9, this is going to be pretty straightforward, just adds everything up from above. And line 10 here, this is adjustments to income from Schedule 1. This could be things like deductible HSA contributions or self-employed health insurance. And a pro tip, a really good opportunity if you're on Medicare and still running a business or doing some side work, you and even your spouse's Medicare premiums can be deducted as self-employed health insurance. And one of the most important lines on the 1040 is line 11, which is going to be your adjusted gross income, or AGI. And that's when you take the deductions from line 10 and subtract them from total income on line 9, and that leaves you with your AGI. And the AGI is the starting point for multiple retirement planning related modified adjusted gross incomes, such as deductibility of IRA contributions, the ability to contribute to a Roth, the amount of Affordable Care Act, aka Obamacare subsidy you're eligible for. And these subsidies can be a huge savings if you retire before going on Medicare. And speaking of Medicare, this will also affect how much you pay in IRMA, or Medicare surcharges, as well as the additional 3.8% net investment income tax. Line 12 is where you will take the standard or itemized deductions on Schedule A. And for 2025, the standard deduction is $30,000 for married filers. And it really only makes sense to itemize if you have deductions more than $30,000. And most people don't. But reasons that you might itemize would be high medical expenses, high state and local tax, or SALT, mortgage interest deductions, and charitable contributions. And if you are charitably inclined, it can make sense to bunch a few years worth of contributions in 1 year in order to take a larger itemized deduction in the year. But if you're over 70 and a half, you should be making any charitable contributions via QCDs or qualified charitable distributions. Line 13 down here generally won't apply, but if you're retired. But if you're not and have a business, this will be your 20% QBI, or qualified business income deduction. And this is one of the largest deductions most small business owners will get. Moving on to line 15, this is your taxable income. And that's the amount that's put through all the various federal tax brackets. And remember, the U.S. is a progressive tax system, so not all of your income is taxed at that marginal rate. And coming down here, line 16 shows tax based on the taxable income from line 15. This is the amount of tax across all those various federal brackets and rates. Line 17 here would be any AMT, or alternative minimum tax, that flows through from Schedule 2, and that really is only going to affect your higher income folks. Line 20 is any additional credits from Schedule 3. And most won't apply, but this is where you'd kind of find your energy efficient home improvements and EV credits and things like that here. Line 23, this includes other taxes, which might be self-employment tax, the additional Medicare tax for high income earners who are still working, or the 3.8% net investment income tax. And the latter applies to passive income, such as interest, dividends, rental income, and capital gains, if your income exceeds the $250,000 threshold for married couples. And a good planning opportunity is to work with your advisor to find ways to keep your modified adjusted gross income below the threshold for the net investment income tax. And drum roll, please. Line 24 here is total tax obligation, taxes owed, and how much of your hard-earned money the IRS will get before factoring in any withholdings, estimated payments, or refundable credits. And after factoring in all those things, you could be left with a refund because you overpaid, or you could have to cut a check to Uncle Sam because you didn't pay enough. And most people are used to getting a paycheck and having taxes withheld by their employer. So one of the questions I get a lot from people who recently retired is, I don't get a paycheck anymore. How do I know if or how much tax I should be paying and when? Well, line 24 is your answer, and it will also be your safe harbor amount of taxes that need to be paid to avoid an underpayment penalty for the current year. So if your AGI, remember that from before, is under 150K, you'll take this number here on line 24 and divide it by 4, and that'll be your quarterly estimated payment if you choose to pay out of pocket rather than through withholdings from a pension, IRAs, or Social Security. And by making the safe harbor payment does not mean that you won't still potentially owe taxes at the end of the year, but you won't owe a 7% underpayment penalty, even if you still end up with a large bill come tax time. And if there is an underpayment penalty for the year, you can see how much down here on line 38. And that's likely a good indication to withhold more or make a bit more estimated payments to avoid that penalty. So coming on down here to payments, we can see here on line 25A, would be any withholdings from a W-2 job. And if you're retired, this likely won't apply. Line 26 is where you'll see how much you made in estimated payments. And we're skipping over a few things here that generally don't apply when retirement planning. But if we come down here to line 31, this would generally be the ACA premium tax credit flowing in from Schedule 3 that I mentioned earlier. And that can be a big opportunity before Medicare. And then line 33 here is the total amount of tax paid for the year. And this could include withholdings from paychecks, IRAs, pensions, Social Security, estimated payments, refunds rolled over from the previous year, and any refundable credits. So what you're going to do here is you're going to compare the tax owed from up here in line 24 to the total tax paid from line 33 down here. And any difference will either be refunded to you, and that'll end up here on line 34, or if you end up owing additional taxes to the IRS, you'll find that down here on line 37. Look, I get it. Taxes aren't sexy. No one ever says, hey, let's get together this weekend and review our AGI. But knowing this stuff, it pays off, literally. That's the power of understanding your tax return. Because it's not just paperwork. When you know how to read it, you can plan smarter, invest better, and use the IRS's own rules against it to lower your lifetime tax bill. I'm Will, IRS enrolled agent and financial planner, and your virtual retirement planning partner. Grab the free guide, drop a comment, and subscribe if you found this valuable. Let's make sure your retirement plan isn't just good, it's bulletproof. And if you want some help doing that, click the link in the description to grab some time with me. Thanks for watching, and I'll see you in the next one, hopefully with a lower tax bill.